About re-strategizing, the plan for renationalization, Michael Joseph made it very clear that it is not what we want to do, but it is what we need to do to be sustainable. Right. What do you make of that, Churchill?
Well, it's not the best of the way out to this situation. So, I mean, I support what he's saying, his sentiments, but nonetheless, that renationalization is not a freelance. I mean, it will now come to the taxpayers' pocket, which will now be able to foot that bill in when it comes to be nationalized. But of course, the recommendations behind it, or the thoughts behind it, is something to make it more sustainable, or to emulate what the other fellow competitors are doing. You find that Ethiopian Airlines, or even the airlines from the Middle East, they are more or less quite subsidized by the national government. So it's something that we are trying to be at par with where the competitors are, at least to, in a way, to reduce the cost. So I think it's not the best way out, but right now it's the only way out.
But Rufus, to counter what Churchill here is saying, not that I remember, but from my reading, when KQ was privatized in '96, the argument was we need to stem this loss-making tide. Right. So now it looks like we are going back to where we were in around '95. And my concern is that I don't think Kenya has ample fiscal space, or deep pockets, if I could say, to be able to continue giving subsidies, especially to an entity like Kenya Airways. I don't know what you would say to that.
Yeah, I mean, I'll agree with the sentiments. It's not the best viable solution here. But who are the takers there? You know, I mean, there's not been any takers to to come and plug in that hole. So the only position they're left with is to approach the government to at least carry the basket until someone shows interest. So as is right now, I think the words by the chairman were right. Short term, I think that's the only sustainable solution. Okay, but long term, I think there's going to be some. But again, looking at just wider industry, that is the norm. Most of the airline businesses are actually backed by, or partially backed by the governments. So, and that in itself has actually contributed to some of the performance we've seen in some of the biggest airlines within Africa. So I guess, look, nationalization, no one wants to talk about it, because there are also the attachments to do with political interference and things like that. But I think if we're able to manage this whole process very well to kind of usher us into a full market position, then that would be ideal. But again, I don't, from an investor point of view, from the market point of view, I think the market is still digesting this whole nationalization narrative. Okay. As just judging by how the things are looking, I think people are not really convinced. They think for similar businesses that are backed by government, there's not so much of a good story to look at. So there's that issue as well.
The Nairobi Securities Exchange itself has just released results this morning, and if you look at the numbers, they're not too good. Revenue is down 18% to around 290 million shillings. Total income is down 15% to about 364 million shillings, and profit after tax is down 89% to 13.5 million shillings. When we look at the Nairobi Securities Exchange as a listed entity by itself, I always like to look at it as a toll station, because all the transactions eventually have to happen there. Mm-hmm. Why are we seeing such adverse numbers from the exchange, Churchill?
Well, it's expected. If you look at the market trend in the last 6 months, you've seen that there's been a decrease in volume traded in the market. So it translates even to the revenues that NSE as a listed company gets at the end of the day. So that's widely expected. You've seen the numbers, the volumes coming down, and of course it has also been represented with the bear run in the market. So it's expected.
Okay.
Yeah.
Rufus, I saw the share price was now oscillating around 11 shillings. It started the year at about 14, 15 shillings. Right. Where do you see this going as far as the NSE is concerned?
Well, the company itself, it's going to take a hit. A bigger chunk of their revenues come from transactional, from the business itself. And as you said, we've seen a big drop in turnovers for both equities and bonds, and so that itself, it was expected that yes, NSE as a company was going to take a hit in their revenues. But just to expand that whole, question, I think they're also into some other misguided, programs like derivatives and things like that. I don't think that does not augur well with the business itself. And then tied into that is we've not seen really an emphasis on more digital trading and things like that. As it is, most of the, I'll say maybe just half, but we need to see a big push towards that direction. We've seen other stock exchanges, right across from Middle East, for example, the Istanbul and some in North Africa, really putting an emphasis on digital trading. We're not seeing it here. So most likely it's going to be the same story. If you look at NSC, most of the revenues really, they're kind of flattish in a way, going back, say, 3 years, for example. Yeah. So it's not a stock that really takes a lot of interest.
Okay.
Yeah.
And just to stay with your comment on derivatives before we go to our main conversation, you did mention misguided strategy. Some of the skeptics of the derivatives market always say that the focus should have been on deepening the liquidity in the market as opposed to launching more complex products. Right. It sounds like this is a view you share.
Correct. Look, we do very poorly. Our turnover rate is about 10%, just on an annual basis, okay? And we've been there, actually the correct number is about 8. Compared to something like, say, JSE, Johannesburg, it's about 30%, okay? The main thrust there should be, should we broaden the space, have more numbers listing, right? And encouraging people to trade. Let's build the core market first before we introduce this other derivatives market. The whole notion behind the derivatives was, let's have, since we have a bigger percentage of our businesses, of the listed stocks traded by foreigners, okay, let's give them an option. The idea was to open up the rest of the market. But when you look at the products that they've already released, right, that they want people to trade in, the same numbers, same names that are already, very active. Yeah. So I don't know what was the aim there. So everything just cancels itself out. So that's why I say it's misguided. And I'm sorry to say, I don't think this project is going anywhere.
Okay.
Yeah.
Churchill, I think you need to share your views on the derivatives, especially around product diversification at the Nairobi Securities Exchange.
Yes, I more or less share the same views as Rufus. We look at derivatives and who are the main takers of derivatives. Ideally, looking around, it's just high net worth clients and institutional investors. Mainly, those are the target market. We are not even talking about the retail market. But I find that right now, most of them are quite risk averse to go into equities. So whatever product it is, be derivatives, bottom line, their underlying is an equity instrument. So that's something which is quite risk averse to them. So I'm not seeing them taking off into this derivatives market, but derivatives product, so to speak. But in terms of diversification of products in the market, I think it's still at an early age for us. As Rufus had just mentioned, we need actually to sort of develop the current market, see, boost liquidity, so to speak. Because if you look at the equity space, we have like 58 stocks in the NSA, but what is the investable stocks that it close to, at the best, is 10 stocks, which are quite investable. So you find that 48 of 58 stocks are not investable, so to speak. So it's something that NSE has now to do, or the regulators, they have to come up and try to boost the market as a whole.
Churchill, allow me to mention that when you talk about equities, you're essentially talking about stocks. When you talk about liquidity, you're talking about the kind of volumes we see being traded on a day-to-day basis. Yes. And that being risk-averse means that your tolerance for risk is extremely low. You don't want to take high risk. It's just good to ensure that we are on the same page with all our viewers. And now let's get to a subject of discussion. When we look at the macro environment, and that we mean the policies being made and the likes, if you read the budget 2019-2020, there was a segment where the now former CS Treasury, Henry Rotich, was speaking extensively about the capital markets, and he even gave almost what we could call incentives, that if a company is in the medium and small enterprise segment, they could be given more like tax amnesty if they haven't had their books in order for the last 2 years, just to try and incentivize listing. Do you feel this could be a shot in the arm for the stock market?
Well, that has been the strategy for some time. I mean, every time CMA yearly give their proposals to Treasury. That has always been one of the main recommendations to at least jig up the tax space. But look, I mean, we are 10 years in, and we've just seen less than 2 real IPOs, right? So perhaps maybe that strategy is not working. Maybe we need to find out why businesses are not listing. Okay, so that is an open question. It's still, it's still a big problem. We'll need to find out other ways. I think perhaps we'll need to maybe start refocusing, say for example, to working together with guys like the venture capital and the private equity funds, right? And if you listen to them, they say selling or exiting their businesses via the stock exchange is really is a preferable option, but the conditions are not right. So I guess maybe that's one way to find out how do we incentivize, how do we make this condition right for them to find that as a viable option. The second aspect is also, well, okay, just to expand on that PE point as well. It's also one way to find an option to increase the listings, but it's also it's a problem in its own because, I mean, these guys are sitting on mountains of capital, so entrepreneurs are finding that as an option. Why should I go list and be burdened by corporate governance and all these things and expose my strategies to the public and competitors? So they find that that's as a very secure option. I mean, I think it released a report about 2 months ago, and they say, last year they raised almost $500 million. So that's capital that is out there that is chasing these opportunities. So why list? So that in itself is also a problem and a solution. I guess the solution perhaps is somewhere maybe in between there. So again, now just to broaden it a bit, it's also a problem, the whole continent, we're not seeing more listings. And that also has to speak to the issue that you raised earlier about liquidity, okay? So most African markets are not deep enough, okay? I mean, with the exception of Johannesburg, most of them don't trade well. Liquidity, again, turnover ratios are, some even as low as 3%. So in other words, these markets don't trade at all. So it's just numbers. It does not matter how many numbers are listed. If the market does not trade, then there's no market. And so that's perhaps maybe the second point is if we're able to unlock that, how are we able to deepen liquidity, make these markets dip, okay? And I think some people have even suggested the point that maybe we need to look at the ESOPs, for instance, okay? So speaking to the issue you've raised on the GEMS market, instead of just allowing 25 shareholders to come and you're good for listing, why don't we first build these ESOPs within the private businesses first? Okay, build it for at least 25, 50, 100. By the time these guys are listing, there's already an internal market that can at least start opening positions. Okay, as we speak right now, specifically for the market dedicated to SMEs, it rarely trades, and you find us, companies there with only 100,000 shares. I mean, how is this supposed to be a market itself? I mean, it'd rather sit in in an over-the-counter, platform. Yeah.
Correct.
So these are some of the issues perhaps we need to grapple with, and maybe a solution may be found.
But Rufus, I mean, where do we find the balance? Because anytime we raise this question with the Securities Exchange, the administration there will quickly tell you, we go for quality over quantity. So you might want to see a lot more listings, but the truth is, and I mean, not to put them on the spot, but we saw the story of Atlas, which was eventually had to be pulled off the market, because the question is not so much how many companies you bring on board, the question is the quality of companies that you bring on board, because at the end of the day, there's reputational risk at a Securities Exchange level, right?
Yeah, you're right. I mean, of course, that's also an important point. Of course, quality should trump everything else. I mean, we shouldn't have, bogus businesses listing, right? And I think perhaps, all fairness, I think CMA is really acting on that very well. But then again, look, do we really have quality businesses worth listing? They are there. And I think just to reference, I think it's the PwC report, which focuses on family businesses. There are whole range of businesses that are qualified to list there. The question is, why are these guys not listing? And I think part of the question they asked, the preference, where they source their capital from. going to list was not even the topmost option for them. They preferred at least to raise internally or to go for a PE. So the question is, how do we recreate the market itself to make it attractive for these guys? So the quality companies are there. The question is, how do we attract these guys?
The cement segment, if you look at Athi River Mining is under administration. We know, and the trading was suspended last year. We know that East African Portland Cement has had its issues. There's actually a massive restructuring ongoing. And if you look at the Bamburi Cement half-year results, total earnings were falling from 1.2 billion shillings to just about 300 million shillings. I mean, that's a serious plunge in earnings. What do you think is happening in the cement sector of this country? If I could start with you, Churchill.
From a revenue point of view, these companies, the local companies, are facing competition from some of the companies, China, Uganda, which their products are quite cheap as compared to the products from the local companies. So you find that on a cost basis, you find that they are losing out from the foreign competitors. So that's another issue that is bedeviling the local cement companies. Also, from a cost perspective, you find that the cost of electricity is quite elevated. These companies are quite resource intensive. They have to run 24/7 at least to be able to produce their end products. But now the cost of electricity is quite elevated. They have not managed to find some efficiency in terms of containing the skyrocketing electricity costs. So these are some of the factors that have had an impact in the bottom line of these cement companies. Yeah, and of course there are some factors which are quite company specific. As you mentioned earlier, ARM has been on liquidation, administration rather, which is more of corporate governance issues. EAPC, which you saw last month at some point announcing restructuring in the company so as to be able to contain the costs. So these are some of the issues that are in the broader cement sector.
Okay, Rufus, on the same.
I think of 2 points. One of them is an overcapacity issue, and as you alluded, those are some of the industry challenges. So you see, as a country, we have a capacity of about maybe 6 million metric tons, maybe slightly less, but then you see, production that is way above those levels. So that's also depressing prices, cement prices, and it's making things a bit murkier. The other issue is also, it's tied to the real estate sector itself. I think the latest banking supervision report says, real estate sector has the most non-performing loans, and a third of them are tied to that. And so that also, kind of, feeds back into their performance. And then, as he alluded, the issue of competition, there are more players, which is also affecting the prices. So all those factors combined, now it's feeding into now their performance. So somebody had a term for them, that particular sector is now called a voodoo sector, because it's nothing but just companies, but nothing inside.
Yes.
Yeah.
Centum has had a number of exits, implying they are getting off some of the investment they had made. They exited at Mercy Beverages, Nairobi Bottlers. We've seen another one around the King Beverage late last week. It looks like their strategic direction is to exit the beverage space in the country and perhaps consolidate in the real estate. I'm not quite sure what to make of that strategy and what that means for shareholders. Rufus, if I could start with you.
Well, I share the same sentiment. It's been a very interesting stock to watch, especially, for several years right now. So just to comment on one side of that question is, yes, you've seen a lot of exits, and perhaps maybe that's informed by, trying to unlock value, trying to, what is this word? Trying to maximize on the return. So in that case, then it's well advised. And across the several names that you've mentioned. Then, of course, there's the biggest play, which is in real estate, that is still ongoing, and a bit of exits here and there. But the other side of the coin is, this is a business that every 5 years keeps on changing its strategic plan. Okay, so that in itself is a big problem, because From one side, you see a business selling itself as a long-term play, but in actuality, it's more like a day trader. Okay, so that change of focus every 5 years in itself does not augur well. Okay, I think well, there are reasons that have been given, and that they're trying to lessen the burden on their asset book. I mean, assets, for example, and to create new vehicles that will tap into, you know, like say for example, in more PE fashion, for instance. So creating funds that leverage not only on their own assets but also other asset, you know, players coming in and combining. So that in itself is well informed. I guess it looks like it's the new thing to do. But again, coming to the core strategy that we've all known Centum to be in, an infrastructure play, well, more like a diversified business, okay, yes, into at least 5 sectors. But we're seeing a slimming down of this, and every 5 years there's a new direction. That to me is a big concern. When you look at its performance itself, is more like a zigzag. There's analysis people saying, you know, it's not a true reflection of its true value, but no one really know how. It's very difficult to put value in a stock that is kind of, you know, seesawing in a way in terms of its direction. Okay. So no one really knows the true value of this business. Mm-hmm. Yeah.
And Churchill, to counter what Rufus is saying, some would argue that perhaps this is a level of dynamism which should be reflected by a company which is keen on a long-term view to be able to adjust to evolving trends within the wider ecosystem, and by that I mean the macro environment. What do you think about Centum's latest moves? Because it looks to me like they're exiting. As you said, we have always known it to be a very diversified company. Now it looks like they're concentrating more on the real estate side, which in this economy is not doing too well. What do you make of it?
It's quite baffling because, I mean, the ideal strategy is to drop the losers and stick with the winners. But by and large, if you look at the whole macroeconomic environment, you find that real estate is quite in trying times in the economy. So for it to still maintain that it's overweight, increasing its allocation or maintaining its allocation to real estate despite the whole macroeconomic development is quite baffling to me. So it's something that speaks of informational advantage. If I may give them credit, we may not know that they're seeing something that the whole market is not seeing, or they will try to be able to have some developments. For instance, the land in Vipingo, which is yet to be fully developed, they could be looking at putting much capital into it or developing it further. So it speaks of informational advantage at this point, whereby they are really quite keen on future developments, but at the moment it's still not, it's baffling to me.
Okay.